So now that we've gone through all of our fields, we're going to go over to the cash flow tab. So this is the inputs tab right here. We've filled out everything in yellow. And now we're going to go to the cash flow tab and see our results. Our purchase price, well, let me back up. We have our address, Kansas, number of units, the 1-unit property. Our purchase price, $181,000. Our loan, down payment, estimated finance and acquisition costs, if we have any repairs. So our total initial cash investment, $41,543. Now, our results on an annual basis, we have rents, $1,700 a month, $20,400 a year, minus 5% vacancy. This is going to give us our expected annual rental income, minus our annual taxes, minus our insurance, minus property management. We don't have property management. He's managing it himself. Repairs and maintenance, generally 5%. However, property is in good shape, reduced to $400. This gets cut off because I had to format this page so it would all print on one sheet. So you can take these with you. But again, if you wanted to see that note, you could go back to the inputs tab if it's too long. We don't have any other expenses. HOA dues, no other items. Net operating income, $14,233. This is simply the estimated income minus the annual expenses. $14,000 is the annual net operating income minus the mortgage payments. And you can see the calculation over here. Principal and interest on $144,800 at 4% is $691.30 per month times 12 months, $8,296. Annual cash flow before taxes, $5,937. So just by inputting everything on our inputs tab, we come over to the cash flow tab and it tells us how much we're going to make every year. Now, we do have some metrics down here that we're going to look and see, is this a good deal or a bad deal? First off, we've got cash on cash rate of return. Charles, tell us about that. What exactly is the cash on cash rate of return?
Well, the great news is you actually have it here. So the cash on cash is your annual cash flow before taxes divided by the amount of money you actually put into the property to close on the property. So in this case, it's the $59.37, which is what you made, your net cash flow before taxes divided by the check that I wrote at the closing, $41,543, or my client in this case, and that's 14%. And what that's really analogous to is if you bought a bond or if you put money in a bank account. What kind of what's your return? You put $100 into U.S. Bank or something. How much are you going to make at the end of the year? Maybe 25 cents.
Not much.
Like 1/4%. So one of the reasons that we love real estate as part of our investing portfolio is you're off the top making, in this particular situation, 14% on this kind of normal MLS property. You're making 14%. So that's what the cash on cash return is here.
Next, we have the cap rate. All right, cap rate is 7.9% on this property. Now, this is another way that people like to analyze properties. This is $14,233. This is the net operating income divided by the price paid for the property, $181,000 right here. So this is a way to consider, if I just paid cash for this property, what would I get as a return? So it's a great way to compare this across other investments as well. Next, we have GRM, gross rent multiplier. Tell me about this, Charles.
So the gross rent multiplier is the purchase price divided by the monthly rent. And it's a very basic way of beginning to analyze a property, but I got to tell you, I love it. You know why? Because when I walk into a property, I can just about do it in my head. Mm-hmm. $200,000 property, we're getting $2,000 a month for rent. Ooh, that's a $100. Ooh, I like that. Yep. A $200,000 property, getting $1,000 a month, a $200. Ooh, I don't like that.
Right.
I like, 110, 120, 130. It's going to depend on lots of things, but it's one of the metrics that we really like. Now, cap rate is more complicated. There's more things to input into it. But what I would suggest for you as an investor is you use these three metrics right here. If you're going to use three metrics, which I think could make sense for you to invest a little bit of time understanding, it's cash on cash, cap rate, and the gross rent multiplier.
Yep. Now, gross rent multiplier, lower is better?
Lower is better in that it's better cash flow. Okay. But what's going to happen is, other things being equal, a lower GRM is going to imply a lower end property in worse condition in a worse neighborhood. So in the Metro Denver area, if you're going to be in, Aurora North, in a normal neighborhood of Aurora North, you might be looking at a typical 120, 125 gross rent multiplier. If you're going to be in Sloan's Lake or Wash Park, you're probably looking at a 200. It doesn't mean that one is automatically a better or worse long-term investment. It's really important to understand it's not that simple. But what it absolutely means is your monthly cash flow in Aurora North with a 125 GRM is higher per dollar spent on the property than in Sloan's Lake or Wash Park. You as an investor have to decide, what are you looking for? And that's where we can help, and good agents and good loan officers can help consult with you on what would make sense for your portfolio.
Yep, absolutely. And you want to look at all these numbers together. Cash on cash rate of return, generally higher is better. Again, with the caveats that Charles spoke about. If you have higher cash on cash return and higher cap rate, these two you want higher. But you may see a lower end property, meaning a property that's worth a little bit less, maybe in a more rugged area of town. GRM, lower is better from a true cash flow standpoint, but it may be a lower end property. And then a piece of criticism that we got for years was we didn't have an after-tax return. So we added just recently the 5-year after-tax return. Now this is 5 years after-tax cash flows, a 5-year exit strategy minus capital gains taxes. So we have put this in here. And really, for Charles and I, we really encourage people to invest for the long term. I'm planning to buy my properties and die with them. But if you think you're going to have a 5-year exit or you want to compare across other properties, you can use this 5-year after-tax return. And so an interesting metric on this, I'm going to go back to inputs. Now, I'm not going to change anything except my annual appreciation. I'm going to leave everything the same here. But I'm going to change this to 10% annual appreciation. All right. And it gives me a little note. Hey, watch out. Normal appreciation is only 6%. If you get too high, it kind of flags you. But look what happens. My 5-year after-tax return goes up significantly, but my cash flow metrics have stayed the same. So my cash flow is the same, but I might make more money on this property if I sell it in 5 years. Okay? So again, we're going to change this back to 6% because I think that's pretty normal. So this is all the all the results from the data that we input, and you should be able to quickly glance and say, does this property meet my metrics and my goals for what I want? If so, great. Let's get in the car. Let's get out there and look at it. If not, let's look at the next property on the MLS. Charles, how long does it take you to fill out this inputs tab?
For me or my clients, if I have the data, which is basically on the MLS sheet, and we know what we're doing, 30 seconds, 45 seconds. So the first couple times you do it, it's going to take longer. But once you do it, you go, wherever there's a yellow cell, then I just have to get that information. I pop it in. It doesn't take a lot of time, and it's so powerful. And where the power comes in isn't when you look at one, it's when you look at one versus another. And maybe the other one has an 8.3 cap. Well, the first thing you're saying is, okay, other things being equal, that one's a better deal. But why is it a better deal? Oh, because it's next to a 7-Eleven. Maybe I don't want to buy a property next to a 7-Eleven. And this is why spreadsheets are very helpful, but they don't answer the question, what is the right property for you? Only you can answer that question. But it's nice to have some data to try to answer that question.
That's right.